Have you ever wondered if stock prices truly reflect all available information, or if trying to beat the market is even possible? Today, we're diving into the fascinating world of market efficiency and a key concept called the efficient market hypothesis. It's a cornerstone of modern finance, and understanding it can significantly change how you view investing. Now, for many Americans, investing is a huge part of planning for the future: retirement, a down payment on a house, their children's education. We see headlines about the stock market constantly, and there's a natural inclination to try and find undervalued stocks, hoping to get a great return. But what if the market already knows everything there is to know and prices are already fair? That's where market efficiency comes in. So what is market efficiency? Simply put, a market is considered efficient if prices reflect all available information. This doesn't mean prices are always correct, but rather that they react quickly and accurately to new information. Think of it like this. If a company announces surprisingly good earnings, an efficient market will immediately incorporate that news into the stock price. You won't have much time to react and profit because everyone else already knows and has acted on it. Now, let's break down the efficient market hypothesis, or EMH. Developed by economist Eugene Fama, the EMH proposes that it's incredibly difficult, if not impossible, to consistently outperform the market. This isn't about whether the market is perfect, it's about whether it's predictable. The EMH doesn't claim prices are always right, just that they're unbiased, meaning they don't systematically overestimate or underestimate future values. There are three main forms of the EMH: weak, semi-strong, and strong. Let's start with the weak form. This version suggests that past stock prices and trading volumes have no predictive power. In other words, technical analysis, trying to identify patterns in historical price charts, is useless. If the weak form holds true, you can't consistently profit by studying past price movements. Think of it like flipping a coin. Past flips don't influence future outcomes. Next, we have the semi-strong form. This version states that all publicly available information, things like financial statements, news articles, analyst reports, is already reflected in stock prices. So, fundamental analysis, examining a company's financials to determine its intrinsic value, won't consistently yield above-average returns. If the semi-strong form is correct, even diligent research won't give you an edge. Finally, there's the strong form. This is the most controversial. It asserts that all information, even private or insider information, is already incorporated into stock prices. This means no one, not even company insiders, can consistently beat the market. This form is widely considered unrealistic, as insider trading laws exist precisely because private information can be profitable. Let's look at a simple example. Imagine a new smartphone is about to be released. Rumors start circulating online, analysts begin issuing predictions, and the company teases the launch with marketing campaigns. If the market is efficient, the stock price will likely increase before the phone is even released, reflecting the anticipated success. By the time the phone hits stores, the good news is already baked into the price. Trying to buy the stock after the announcement will likely result in missing out on the initial gains. Another example, let's say a major coffee bean crop is unexpectedly damaged by a frost. This will likely impact the stock price of coffee companies. An efficient market will react immediately, driving up the prices of coffee stocks as investors anticipate higher prices for coffee. If you waited for the actual shortage to hit stores, you'd be too late to profit. Now, why is this relevant to the average American investor? Well, understanding market efficiency has huge implications for your investment strategy. If the EMH holds true, it suggests that active investing, trying to pick winning stocks or time the market, is a losing game for most people. You're competing against thousands of other investors, many of whom have access to sophisticated data and technology. Instead, the EMH supports a passive investment strategy, like investing in index funds or ETFs. These funds simply track a specific market index, such as the S&P 500, providing broad market exposure at a low cost. If you believe the market is efficient, trying to beat it is futile. You're better off accepting average market returns and minimizing your costs. However, it's important to remember that market efficiency isn't a perfect science. There are times when markets can be irrational or mispriced, creating opportunities for skilled investors. Behavioral finance explores these anomalies, suggesting that human emotions and biases can sometimes lead to market inefficiencies. To summarize, market efficiency refers to how quickly and accurately prices reflect available information. The efficient market hypothesis suggests that it's incredibly difficult to consistently outperform the market, and that a passive investment strategy may be the most sensible approach for many investors. While perfect efficiency doesn't exist, understanding the concept is crucial for making informed investment decisions. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.